welcome back to FX Street. Welcome, good morning, everyone. It's August 20th, Thursday, 2009. Welcome back, one and all. Great to see you, Street. Great, really big crowd. Wow. Very special thanks to FX Street for hosting this webinar. My name is Adam Rosen. I hope everyone can hear me okay. Please, someone let me know that the audio is working okay. We're very happy to be here today. Hello. And we have a very, very fun topic. We're going to talk about day trading today. It's great to see all the regulars here. Now, you should see in front of you a chart. Before we get started with day trading, I will digress for one moment. You should see a chart in front of you marked the symbol CL. This is crude oil, the crude oil futures actually. Okay, 73.57 is the current price of crude oil. Now, the reason why I mention it is because yesterday's high, 74.25, surpassed the highs of June 30th. And if we zoom out on the chart, we'll see that crude oil has not touched 74.25 since late October 2008. So we're looking at 6-7 month highs. Now, if we trade crude oil, obviously this is very important. But how does this benefit us in terms of foreign exchange traders? And this is something I want to bring up a little bit later on in the show. Hopefully be able to tie everything together. But it's certainly very, very important that we know that there are market correlations that exist. Why is oil so strong? Well, some perceive that an economy that we perceive as being stronger, if we're in fact in some sort of recovery in the U.S. economy and the other economies overseas, if it's perceived that we're in a recovery, well, the market says, okay, we're in a recovery, we can afford to buy more crude oil, we can take more airline flights, and we can buy gas guzzles on the automobiles, whatever it may be. We can also make money by trading the Canadian dollar at times. It's a very good point. There's not a perfect correlation between crude oil and the Canadian dollar, but at times the two markets are really lockstep. And the reason I mentioned crude oil to start off with is because so far we do not see Dow Jones Industrial Average breaking to new highs, nor do we see the currency pairs. Some currency pairs in particular break to new highs. After all, when the Dow Jones Industrial Average goes up, this tends to absorb capital away from the safer assets. You see, the Dow Jones Industrial Average, well, stocks in general, they're considered to be a little bit more speculative. So when things look good, well, we buy more stocks. When things look, optimistic. When things look pessimistic, we sell stocks and we buy bonds. But when we buy stocks, we're also buying higher yielding currency pairs. These higher yielding currencies like the Aussie and the Kiwi, the Australian New Zealand dollars, because they have higher yield, are also considered to be a little bit more speculative. So an economy that can afford to take a little bit more risk in the stock market, that can afford more crude oil, well, we would certainly expect the markets to go up, and they do together. Dow Jones Industrial Average right near the highs, crude oil barely at new highs on a pretty long-term basis. Now, in terms of the foreign exchange market, we know when capital goes into crude oil and into the Dow Jones Industrial Average, it comes out of lower yielding currencies like the dollar, like the yen, like the Swiss franc, because the low yield are considered to be a little bit more safe, but maybe not so, maybe a little bit more boring in terms of gaining yield. It's a lot more interesting to gain 3% in Aussie as opposed to, almost nothing in Japanese yen or US dollar. With that said, we do not see a breakout in the Dow Jones Industrial Average. We do not see a breakout yet in any of our foreign exchange currency pairs. So there's a little bit of divergence. There's a difference. Why is crude oil at new high? Why is the Dow Jones Industrial Average not at a new high? The question is, eventually I think the two markets, or all the markets, will come back together just by the natural ebb and flow of capital in the financial markets. So the question is, will crude oil drop back down? Is this a big double top, a false breakout? Or will crude oil continue higher, and will the Dow Jones Industrial Average possibly break out in the next couple of days or next couple of weeks? And what will happen with the foreign exchange market? Will we see Aussie yen at new highs and Kiwi yen at new highs? Well, that is the real question that we hope to answer by following the charts. As far as our topic today, day trading, well, it all kind of comes hand in hand. What I'm going to do is I'm going to try to share with you a philosophy as far as setting up the day for trading, going from the daily charts all the way down to looking for those day trades every single trading session. We have three major trading sessions. European trading session starts around 3 a.m. Eastern. That's when London opens. The U.S. trading session around 8:30 a.m. Eastern. And the Asian session at 7 p.m. Eastern. So, with that said, as every trading session opens, when London opens and the FTSE and the CAC and the DAX and the European equity markets open, we expect more volatility. Well, this volatility usually lasts for the first 2 to 3 hours of every trading session. During those volatile times, we can look to find breakouts and breakdowns. We're going to go over all of that. But the first step really is currency pair selection. Because if we're looking for, well, the first thing we want to do when the market session opens, whether we wake up at 2 a.m. Eastern, we get ready to trade the London session, or wake up at 7 a.m. Eastern and we plan to trade the U.S. session, we should, obviously prepare about an hour before. Going through the charts is a very, very useful tool. It should be step number one, turn the computer on. I immediately open up the charts, go through all the charts, see if anything has changed, if maybe something that I didn't see yesterday appears for me today. If nothing else, it's a very nice refresher course. So I have a visual image in terms of a long-term basis, which way the chart's heading. Now, there's a lot of lines over here on the euro-dollar daily chart. I can erase some of the lines. They're probably not necessary. I draw them at some reason or another. For some reason or another. At any rate, we see that the euro-dollar is in a massive, massive trading range. That's the first thing we should do is try to, really frame the market in terms we can understand, define, is the market in a range-bound or trending pattern? Now, range-bound is exactly what we're looking for. We go up a little, down a little, up a little, down a little. We fail to make new highs or new lows over a certain period of time. It's really up to you, as we did in the past. Take a look at from April to June, we went from euro-dollar 129 to euro-dollar 143. That's a lot. That's 1,400 pips in just a couple months. Well, over the past few months, we went up a little bit higher, but quickly, if we had bought, we probably would be losing a little bit of money right now, or maybe at best breaking even. Not Dow, but the euro-dollar is in a range-bound pattern. So what does it tell us? Do not expect big moves. So many times I still remember making the same mistake. You take a look at a chart and it looks range-bound, and we say to ourselves, this is range-bound. I don't expect the euro-dollar to go anywhere great. So, as time goes on, I go to a 5-minute chart or a 15-minute chart and look for a day trade, and I find a trade and I get in and I start making 10 pips and 20 pips, maybe a little bit more, and then I start to, I forget that the euro-dollar on a long-term basis is in a range. And we start to imagine, wow, what if it goes 50 pips? What if it goes 100? What if it breaks out? And we start seeing the breakout that has not even occurred yet. So that certainly is a very, very dangerous habit to fall into, something that I'm sure a lot do. I have done in the past. That's absolutely for sure. So, but point being is that the euro-dollar in a range-bound pattern, we do not expect anything big. But within a range-bound pattern, study the significant lows, significant highs, support and resistance to see where the good buy and sell areas are. Euro-dollar in a range-bound market does not mean it doesn't have any use for us. Quite the contrary, it does. But I would not expect big moves. I've made the same mistake over and over and over again. Take a look at the recent lows of 140.45 on August 17th. Before that, 140.07. So cutting that in half, we can give it a range. We can say 140 to 140 and a half seems to be our support. In fact, we can adjust this trend line as follows just to make it a little bit easier to see. This is our immediate short-term range, 140 on the low side. Now take a look at this. Looks like a head and shoulders pattern. The second shoulder, the highest high we see is around 143.26. The candlestick's around that 143.06. So we can say about 143 to 143.50. So we have 140 to 140.50, up to around 143, 143.50. I'll zoom in a little bit, and it's a very nice tradable little range. Now, if we're near the top and we see a reversal and a possible short trade, I love it because I know I can place my stops above the highs, above this 143.5 level, and I don't want to say I'll be safe, but I won't get stopped out of the trade unless the market really breaks out. Expect the market to do, this is something that a friend of mine taught me a while ago. A long time ago. He says, expect the market to do what it's done now. Don't expect anything different, meaning that we see the euro-dollars in a range, and if we zoom out on this chart, the euro-dollar has been in this nasty range from the beginning of June. So we have all of June, all of July earnings season, which is usually a volatile period of time, and half of August now. We have 2.5 months, 10 weeks For the past 10 weeks, the euro dollar has not been able to break out one with the other. Is it the euro dollar's fault? Well, the euro dollar is just simply a reflection of the price of two currencies. And the fact of the matter is, lately, as the dollar's been going up, well, the euro kind of goes up a little. And if the dollar goes down, well, the euro kind of follows it. No rhyme or reason, and this definitely I don't think will continue to happen. The euro on its own has been very, very, very quiet. So point being, do not expect big things to happen. On the other hand, if we were in a trending period, I would say, well, first of all, if the trend is your friend, I only want to trade in the same direction as the trend. That would be in a trending strategy. But in a range-bound strategy, use what the market gives us. The market's giving us a range with a very high probability. We're not going to see the euro dollar below 140 or above 143.50 anytime soon, especially considering the fact that we're in August, which is a quiet month. I want to talk about that as well. Now, another tool we can use. Now, that all we've done is really just try to frame the market into something we can understand. Is it range-bound or trending? If it's trending, which direction is it trending? It's making higher highs or lower lows. Now, you should see an indicator at the bottom. This is the ATR, the average true range. The ATR, going back 14 periods, measures basically, it's a little bit more complicated than the calculation, but it basically measures the length of every candlestick from the low to the high, basically the average trading range of every single, on a daily chart, it's going to measure back 14 days, 14 daily candlesticks. On a 5-minute chart, it'll count back 14 5-minute candlesticks. But on the daily chart, the ATR has been declining steadily for quite a while, actually since the beginning of June. Now, what does this tell us? Well, very simply, it tells us that the average range from low to high of the candlesticks has continued to decline over time. That we're not going up as much, we're not going down as much, the candlesticks are getting smaller. And this just simply agrees with us and tells us, hey, we're in a range-bound market. Now, there is a very viable strategy for range-bound markets, but before I get to that, I want to talk about trending. So again, define the market in terms of support, resistance. Are we in a range? Are we trending? Does it look exciting? Does it look very boring? Use that information. That's probably step number one. So I'll chat these and so try to keep track of them. So step number one is to identify range-bound versus trending. Okay, that's a very simple way of saying it. Step number two is daily. These are all on daily chart, by the way. Daily chart ATR, is it inclining or declining? Okay, sorry for my spelling. So, a declining ATR shows us that the volatility continues to shrink and shrink and shrink. Now, there comes a point when the ATR declines so much that there is a very good probability that the market's going to explode to the upside. Explosions come from very, very quiet markets, and very, very quiet markets are the result of an explosion after the fact. So just please be aware that eventually, when the ATR starts to go up and at a very steep angle, be aware the market has a good chance to break out. But my suspicion is, chances are, we're going to see that breakout on our technical analysis, on our support and resistance lines as well. That's another very good way to confirm it. So let's look for a currency pair that's been a little more exciting. If anybody has any suggestions, I would certainly love to hear them. Off mind, I'm going to think about the pound yen. The pound yen, well, what a messy chart. So we're going to erase all these lines and we'll start from scratch, which is the best way. Okay, now the pound yen on a daily chart, cable yen, long-term trend to the upside. Depending on how we draw these support and resistance levels, we either would have broken a support level as follows, but then again, that support level is no longer valid, so we can't use that. And then we draw our resistance by connecting significant highs. A long-term trend to the upside is certainly evident. Now, zooming in a little bit, now that we've established a trend as your friend and there's an overall trend to the upside, what are we looking at right now? When was the last time the market actually made a new high? Well, that goes back to August 9th, but we barely made a new high. In fact, it kind of looks like the euro dollar, a little bit of a higher high, but certainly we have not traded higher highs than that since October of last year. So the cable yen certainly has not been exceptionally strong lately. And in fact, going back to, well, I would guess by the beginning of June, the cable yen, like the euro dollar, is in a range-bound market. Now, furthermore, I would certainly just note this because it's very, very interesting. Take a look at the lows of 154.05 on June 23rd. That, I think, represents the first shoulder of a possible upside-down head and shoulders. The head at the bottom, 146.74, that's on July 8th. And then the second shoulder, which the rule of thumb is it should not come too much higher or lower than the height of the first shoulder, in this case the downside. So we broke the lows of 154.05, going down to eventually lows of 153.44, only about 50 or 60 pips. The cable yen, it's actually miraculous, it was only 50 or 60 pips. Now, so we know over the grand scheme we're in a long-term trend to the upside, but for the past couple months, about 10 weeks or so, we've been in a range-bound market. Let's take a look at the ATR, see if that helps at all, though. Remember, the ATR and the euro-dollar was really declining at a quite rapid pace. This is refreshing, though, despite the fact that we're also in technically a range-bound, channel within this long-term trend to the upside. The ATR, which did hit very, very significant lows, we saw going back to the beginning of July. Well, guess what? Earnings season, beginning of July, the market explodes, the ATR explodes. And this is what you want to see when we see ATR explosions, that almost vertical climb to the upside. That shows us going from very, very quiet candles. Remember, it counts 14 candlesticks back, takes the average in some sort of way. Going from these very, very short candlesticks in 180 pip range. Then take a look at the big one, 146.74 to 152.91, 47, that's 6.7, that's a nearly 700 pip range. We went from days of seeing cable yen only traveling 180 pips from low to high to 700 pips. That's what, 3-4 times the ATR. When we see the ATR obviously inclined following that increased volatility. What's refreshing, what I like to see now, is despite the fact that we're in August, which is a quiet month, despite that fact that the euro dollar and I'm sure other currency pairs have declining ATRs, the cable yen currently is showing an increasing ATR. That's good. That's what we want to see because it shows the market has the potential to break out. So now we've located or identified the one currency pair that is a likely candidate to look for day trades. Now I would really go through these steps with every major currency pair, chart that you follow, euro dollar and the pound dollar. And we can watch gold as well, and I'll get to that in a second. Dow Jones Special Average, we can perform this exercise in virtually a lot of different charts, always starting with the daily chart. Again, step number 1, range bound versus trending. Step number 2, check the ATR, is it inclining or declining? Now what we have here is an inclining ATR. Now let's go to a 5-minute chart. I'm going to take away the ATR because now we don't need it because we know it's inclining, and that's not going to change anytime soon. Now, let us identify the trading sessions. We have a trading session. It started, 10:18 a.m. Eastern at the moment. So, 9:87. Okay. No, only 2 hours back. Okay. So we'll go 2 hours back, and we're going to draw a vertical line. This, if I did my math correctly, represents 8 a.m. Eastern. Okay. Now we're going to go back a little bit more than 8. We're going to go back to around 5, so minus 3. And then from 5, we'll go back another 2. And there's a rhyme and a reason to this, I promise you that. Okay. All right, so the line all the way on the left-hand side represents the 3 a.m. hour if I did my math correctly on the cable yen. Now, we know that in every currency pair, like the pound yen, there are 2 currencies, and each currency tends to be most active during its own respective trading session. It's an important little tip. I think, everyone knows this, but I think some of us, I sometimes forget about it. I remember one of my first, jobs, positions, trading Forex. I was trading in a room, I was trading the Asian to European hours, and I was very, very new, and I was watching the charts, and I went to my manager's desk, and into his office. I said, "Tell me something." I said, "Why is the dollar yen so quiet? What's going on? How come I was trading the dollar yen all afternoon, and it got very, very quiet." I said, "Why is the dollar yen so quiet?" And my manager at the time, he says, "Hey, so you look at the clock. It was 2 a.m. in the morning. 2 a.m. in the morning, the Asian sessions have already quieted down, and everyone in New York is asleep." So, with that said, there's no real reason for the dollar yen to move. More specifically, there's no economic numbers being released after the first 2 to 3 hours. Those first 2 to 3 hours of every trading session are precious. That's when we receive all this economic data. then the markets get volatile. Well, at 3 a.m. Eastern, the London market opens. Now, we have the yen. The Japanese market is also open that time. It's not necessary for both markets to be open. We just need one currency to be active. Now, I like cable yen because it's usually a good match in terms of creating a trending currency pair, because what we're simply looking for are breakouts. So at 3 a.m. Eastern, we see the markets have been very, very quiet before then. Actually, not really. It's cable yen's not a good example. But what we're looking for essentially is we're looking for a significant break. Let me erase this line over here. We're looking for a significant break. Now, it's a 5-minute chart, and I would not recommend skipping directly from a daily chart to a 5-minute chart. To be quite honest with you, I like to move from a daily chart to a 4-hour chart to a 1-hour, and then maybe a 5-minute chart to look for the execution. But in terms of the sake of preserving time, this is the process. Eventually moving to the 5-minute chart, marking up the 3 a.m. hour, and we take a look. Well, I marked the blue lines at recent swing lows or swing highs. How far back do you go? It really is different with every single trader. Now, I just look for the most recent significant highs, which is certainly the highest high we saw here, 156.62 on August 20th. That's today, obviously. And the lowest low of 155.87. Now, true, we can go back further and take lower lows, but I like to just identify the range the market has enjoyed just prior, basically the hour. Let's see how much time I actually factored in. This is 3 a.m., just to give us an idea. That's 9, going back. So I went back about 3 hours. I would say about 3 to 4 hours is more than enough just to see. Some of you traders even look back only the past hour or so. But at 3 a.m. Eastern, we have the support and resistance. We know the market's going to get active. And from 3, when did the market actually break out? The market broke out at 4:30. Now, if I recall my economic calendar, there was UK news today at 4:30 a.m. Eastern, which certainly explains why the market broke out. So what I would do is I'll say step number 3 is always consult the daily economic calendar. If you're looking for a suggestion, the one I use is found at the top of dailyfx.com. But Bloomberg.com has calendars, and many sites do. At any rate, taking a look at the support right around 150, rounded up to the largest round figure, about 156, and the highest high, we went up to 156.60 or so. So 155.80 to 156.60, that's about an 80 pip range, not too bad. Now, we went slightly above it. Long candlestick wicks, beware of, especially in a 5-minute chart. I don't want to buy at the first long candlestick wick. We want to look for some kind of confirmation. How many candlesticks? Well, another strategy I use for day trading, I use 3 5-minute candlesticks. So we want to wait for 3 5-minute candlesticks to close below the support or above the resistance. So in the case of the cable yen 1, 2, 3, and we actually sold off even more from 155.86, we then hit lows 155.63. Down another 20 pips, but we rallied back up. Nice red candlestick confirmed that the market, in fact, didn't move to the downside. Now, the market very, very quickly then sold off from the 155 area, 156 almost area, down to lows 154.82, about 100 pips sell off. But cable yen, and we don't certainly expect to capture the entire 100 pips in a day trade. To capture 30 pips or 40 pips would be a really, really nice gem. Where to place the stops? This is a different question. This, again, we have to look at the charts and see where were the recent swing highs and swing lows. With this cable yen trade, it's a little bit tough because we have an 80 pip range, but at least going back to the 156 level, if we believe that the 156.00, that figure is our new resistance, our former supports, we should place the stops, theoretically or realistically on top of 156 figure. 156.30 is a nice number. So to have a 1-to-1 risk-reward ratio is something that we never see in terms of day trading. Day trades usually don't have good risk-reward ratios. At any rate, we sold off 100 pips. We're able to capture in our little day trade for the day, and then the market gets quiet again. Now, the market gets quiet again because we have U.S. numbers at 8:30 a.m. Eastern. So let's mark off our support and resistance lines again. Now, you may ask, well, the London markets have cooled off by now, and the U.S. markets aren't open yet, but, the Japanese markets are closed by now. Why are we trading cable yen during the U.S. hours? There are exceptions to the rule. Cable yen tends to remain relatively active because the yen plays such a large role in the foreign exchange world in terms of absorbing currency. If there's good news in the U.S., the dollar might go up, but the yen's going to go down because we're borrowing cheap capital from the yen and buying higher yielding currencies like the Aussie and the Kiwi. So please keep in mind that not all currency pairs are designed to trade in all time sessions, but the yen crosses, the volatile ones, certainly can be useful. Now, the next chart is the Aussie yen. Well, let me go to the gold, and then we'll go to the euro dollar. There's a lot of indecision. I already went through the euro dollar, but there is a lot of indecision in the euro dollar. I certainly do agree. Gold is a real challenge. 939.40 with an uptrending intermediate support level. If you draw that support from April 17th lows, that's April 17th of this year. And we see a triangle consolidation inside a massive triangle consolidation. I see, without looking at the ATR yet, I see lower highs, higher lows. This all tells me contraction, contraction, contraction. Taking a look at the ATR on a daily chart, if you look at the weekly chart also, I'm sure it would look very, very similar, probably even more contracted, relatively speaking. The ATR is near a very, very significant low. Going back, the ATR currently, that's the average true range again, currently around 12 or 13, if I get the mouse on right. The lowest low I see is just below 12. The ATR essentially has not been below 12. Well, we got to go back to October 2007. So the gold market has certainly become very, very quiet. Now, why did gold go so much up, so much to the upside as in the late 2007, 2008? Well, gold represents a tremendous flight to safety. Capital moves into the gold market, it moves into the Swiss franc, which tracks the price of gold pretty closely at times, and it benefits when everything else goes down. The question is, so first we mark the highs and lows of the Asian session at the start of the London Open at 3 a.m. Eastern, and from there identified support and resistance. Is that correct? That is correct. I would not even, it's a great question, you are 100% correct. However, I would say, I don't think it's necessary to mark up the highs and lows of the entire Asian session. Some traders look back an hour, meaning if the European session starts at 3 a.m. Eastern, look at the highs and lows from 2 a.m. to 3 a.m. or from 1 a.m. to 3 a.m. The last 1 to 2 to 3 hours. Which is best? It really depends on a chart-to-chart basis because, we have to at least see the significant highs and lows. The cable yen was a little bit of a tough example. Let's look at the Aussie yen and try to make sense of this as well. Now, the Aussie yen in a long-term trend to the upside is now in a massive trading range. The ATR does not look so hot right now. We can actually draw trend lines on the ATR itself just to give us an idea. If it's not clear, sometimes this really helps me. Draw significant support or significant lows and highs. ATR is contracting. That is normal. But we're continuing trend to the upside, to the downside in the ATR. The volatility is continuing to decrease. And that means that we have a good chance that the ATR is going to fall down again. And we're actually probably at a pretty close time. So the Aussie yen is not as exciting of a currency pair as the pound yen. It would be really interesting to see if we had time to go through all the different currency pairs, which one had the highest and lowest ATR. I'm guessing the pound yen. I'm guessing maybe the pound dollar. The pound has been very, very active lately. I'm guessing it's certainly not the euro crosses. Okay, so we've done our homework in terms of the Aussie yen, and let's look at a better example. Let's go back to the euro dollar, a really quiet market. You should see the euro dollar here. Now, we mentioned before August being slow, and this also we can use to our advantage. In the same way that the markets become active at 3 a.m. Eastern and tend to continue to stay active for the next 2 to 3 to 4 hours. So London is active from 3 a.m. to around 5 or 6 a.m. Eastern, and then we get quiet. And then the U.S. session is usually active from 8 a.m. Eastern to around 11, and then things get quiet in the U.S. after all the numbers have been released and after the traders have traded, and now they've gone to lunch, the markets get quiet. The markets on the yearly calendar also go through the same cyclical pattern, meaning we have corporate earnings season quarterly, January, April, July, and October. We just came through July. July, an extremely active, probably the most active time of the year. The euro dollar chart, we would not be able to see it, so we'll go very quickly to a Dow Jones Special Average chart and show you exactly what happened in the month of July. Take a look at the lows of the Dow Jones Special Average. Going back to July 13th, that was around 8,000, a little bit above 8,000 on the futures. From July 13th to August 13th, exactly a month, we went from 8,000 to highs of 94.26. We'll call that 94. That's 1,400 points in one trading month. 20 trading days, that's what, 70 points a day, if I did my math correctly. 70 points a day to the upside we averaged for 20 straight trading days. Very, very few red candlesticks. The trend is your friend. If we were to imagine this in a 5-minute chart, it would have been really nice to buy breakouts and sell breakdown, or just buy breakouts. Trend is your friend. Just go long and long and long all through the month of July. Well, notice once we hit August 13th highs, from August 13th now August 20th, it's only about a week or so. We've made very, very little progress. Let's plug in the ATR to the Dow Jones Industrial Average chart, and we can see, remember, the ATR is a lagging indicator like most technical indicators, like all technical indicators, it's lagging. So this increase that we see at the end of the line represents the move we had in July. After all, the mouse right now is on August 19th, but this counts back 14 candlesticks. So what this is doing is it's waiting for the market to really show us there's a big turn. Always a clear sign. We came all the way down and had a big spike up. That was a nice sign that the Dow Jones Industrial Average was a nice trend to the upside. Now we see the ATR starting to turn to the downside. Very, very quickly, things have gotten quiet. I do not expect big breakouts in the Dow Jones Special Average. Now, in terms of the yearly calendar, the way it works is we have January earnings season. Things are very volatile. All that capital from the mutual funds that we had to take out for tax reasons, well, it's now thrown back into the stock market, thrown back into the economy. Mutual funds are allowed to reallocate to their positions, make their adjustments, etc., and things get crazy in January. Well, things are crazy, and then we have February, and we have March, and things are kind of quiet. Then we have April, earnings season again. May and June, kind of quiet. We're getting ready for the summer. July comes, the most active trading session of the trading month of the year, I think, is July, and followed by, in my opinion, the worst two trading months of the year, which is August and September, because we're right in the middle of a period of time when a lot of traders, a lot of market movers are on vacation, a lot of central banks aren't doing anything, the Congress is on vacation, there's no real big economic data we expect. So July, the transition from July to August, I think is so important. We go from the most active month of the year to the least active month of the year, and that transformation occurs within about 1 week. I think we just finished that first week of transition. Now, we have the rest of August, and we have September as well. Certainly is choppy. October, we have earnings season again, though. October can also be known, and historically, it surely has been a very, very volatile month. And then we have all that capital that's taken back out of our gains, and we hold it until the new year, and the cycle goes around and around. So, how do we make money? Well, I would not necessarily want to look for breakouts. Remember, we looked at the ATR and the cable yen, and that looked good, but the Aussie yen looked bad, and the euro dollar looked bad. I'm guessing that if we went through all the currency pairs, the ATR would look bad on almost all the pairs, and that tells us stay away from trading breakouts. Stay away from expecting the market to explode one way or the other. Let's take a quiet currency pair and match the currency pair with the market environment. If we believe that the market's quiet right now, let's trade range. If we believe that the euro dollar in a range bound market, hey, the ATR tells us we're in a range, support and resistance tell us we're in a range, well then it's better to trade in a range. The currency pair, the euro dollar, is telling us we're in a range. The ATR is telling us we're in a range, and the month is telling us we're in a range. Well, 3 things tell us we're in a range. Why not trade a range? Now, taking a step back, it is 10:30. Okay, so back 2 hours, 2.5 hours. That's the U.S. Open. Now, go back. That's at 8 a.m. Eastern. Go back 3 more hours. 6, 5, 4. Okay, if I drew these lines correctly. Even, I'm looking for an example where I'm sorry to keep you waiting. I'm looking for an example to really show you it's a bad idea to look for range-bound trades during the active session, but there's a lesson to be learned from this. I'm actually kind of glad I came across. This is a 5-minute chart euro-dollar. Well, this big explosion we saw in the euro-dollar, that was yesterday. That doesn't count. We're looking back to the European trading session right now, 16, so it's 4. Okay, so that's about the European trading session, what we're looking at right here. We saw, I'm just approximating here, we saw the market active yesterday. Now we're in a range, and the euro-dollar, which again, the euro-dollar currency pair is in a range because neither the euro nor the dollar can seem to get out of each other's way. We're in the middle of August, and that is certainly a range-bound trading climate. And the ATR and daily charts also telling us the euro-dollar is very quiet. So from this point moving forward, we can look at a 15-minute chart, we can look at a 40-minute chart, a 30-minute. It's a great point. I'll go to a 15-minute chart just to show you that this application can be used. Now, 15-minute chart, you're gonna obviously need wider stops, wider limits, and a little bit more tolerance for pain. 5-minute charts is used, obviously for scalping purposes. I don't particularly love 5-minute charts, but they do serve a purpose. But all the same, we're on a 15-minute chart of the euro-dollar, and we plugged in our Bollinger Bands. The center line is a 20 simple moving average, and the two lines is that simple moving average, 2 standard deviations below and above. And we marked up the European trading session here with these white horizontal lines roughly, and even though we were in the active session for, about 1/3 or at least 1/3 of this little box over here, the market failed to break out or break down. Bollinger Bands are an excellent tool to be used to trade range-bound markets. Very simply, wait for the candlestick to close above and then cross back below the upper Bollinger Band. To cross above and cross back below the upper Bollinger Band, selling short, placing a protective stops above the highs, trying to take profits in the center Bollinger Band or ideally at the bottom or somewhere within the meat of this range. It really depends how optimistic you are that we're going to come all the way back down or just revisit. Now let's just take a measure in the Bollinger Band to give us an idea on a 15-minute chart. What does this range look like? From a high of 142.40 to lower Bollinger Band 142.20, that's about 20 pips. When the band's expanded 142 to around 142.50, that's about 50 pips. That's on a 15-minute chart. If that's not enough, if we don't want to risk 20 pips trying to make 50 pips, or trying to make 20 pips, I should say, go to a longer-term chart. Now, a longer-term chart, we have to, obviously keep in mind that we're going to need larger stops and larger limits. But when last time the euro-dollar was in a range, 140.60 supports, or at least lower Bollinger Band, 140.140, that's about 80 pip range. That's on a 1-hour chart. We can go to a 5-minute chart, and the Bollinger Bands also certainly adjust accordingly. Lower band here, just taking an abstract point on the charts, 142.08, the upper band 142.26. ATR is declining on 15 and 1 hour. I would not be surprised as well. The time frame of the chart is completely up to you. I would only say to establish this time frame before you go ahead and look for possible trades. But I would say conceptually, more than anything, going through, and I'll try to type these in as well. 3 factors to consider. Okay, so we have time of day, time of year. We have specific currency pair in terms of range bound versus trending. Okay, and what was the third one? We could also use ATR and other indicators. And of course, when we talk about the time of day, time of year, also please include the economic calendar of the day. Now the question is, do you look for topping or bottoming patterns? Absolutely yes. In range-bound strategies, you want to look for double bottoms and double tops. After all, how do we draw support and resistance? Connecting 2 significant lows, the third time the market tests and fails to break below that line, that's your spot to go long. Same holds true for resistance. Do I look for topping and bottoming patterns in the ATR? I know you're referring to. I don't particularly. I'll explain what you're referring to, if I understand correctly, is looking for some sort of discernible reversal pattern within the ATR itself. Meaning, here's a double top on the ATR. Here's an incline. I like to look for inclining highs, inclining lows, declining highs and lows as well. This I like to do. Draw that downtrending resistance. I know everything is blue here. The ATR continued to decline at the same rate and did not violate this resistance line while going back from June 18th to July 28th. That's more than a month. That's about 5 or 6 weeks, and the ATR just continued to decline. Now, eventually, the first signs of a breakout occurred July 23rd, and the ultimate breakout July 27th up until the spike high of August 8th. As that ATR started to incline, if we had said, hey, notice the ATR just broke out over here, I'm going to draw a line in the chart, and I'm going to make a mental note of this. The ATR starts to look good around here. I'm going to start to look for breakouts. Well, the next thing you know, take a look at these candlestick ranges. This candlestick of 140, 156, and 142, 56, that was July 22nd. That's a cool 100-pip range. Then the ATR breaks out. We had a couple of days to realize it. Take a look at these candlesticks. Now we see 140.06 low, 141.94 high. That's almost 200 pips. And then we have July 31st, 140.62 to 142.79. That's about 210, 220 pip range. So notice as ATR broke above its downtrending resistance, volatility started to increase. And if we're in August and we want to look for range-bound currency pairs, maybe the euro-dollar isn't the right one right now because the ATR is not telling me it's perfect. The question, I apologize to forget that question. I'll read it right now. Do the euro-yen and pound-yen follow Dow too? They follow the S&P. It's a great question. I would say there's a very, very strong correlation between the Japanese yen and the Dow Jones Special Average. Why? Capital under very, very low interest rate environment in Japan is sent into U.S. dollars to buy U.S. stocks when things look good, when the perception is that the Dow Jones Special Average is going to go up. So capital comes out of the yen, we sell short yen, and we buy stocks. But in order to buy stocks, we have to convert that capital into U.S. dollars. Well, that explains the dollar yen. However, keep in mind the foreign exchange market always likes some currencies and doesn't like other currencies. Well, when things look optimistic, lately, the recipe has been to buy Australian dollars and New Zealand dollars because they have higher yields and they're considered to be more speculative. So Aussie yen has a good correlation to Dow Jones Special Average. I would say when the pound is strong or when the euro is strong, yes, they would follow the Dow and S&P indices as well. But the problem is lately the euro has been really, really quiet and the pound has been the steady trend to the downside. So what happens when the stock market goes up? The stock market goes up, the yen goes down. Remember, the pound's been kind of going down also. And that creates a really messy range-bound market. We don't like to see two currencies going in the same direction. That means the capital is moving into both currencies at the same rate. We'd like to see currencies running in opposite directions, out of one into the other. That's what creates trends. And that's what I really like to find out. So please, again, keep in mind the three factors to consider: time of day, time of year, economic calendar, of course. Specific currency pair, go through the exercise. It's very, very easy. Support resistance on a daily chart. Throw on the ATR. See if it's inclining or declining. Consider the time of day. And then consider also and I know I mentioned this already, the time of the hour, meaning the time of day and the time of the year. It's August. Things are quiet. Things are also quiet in between active periods of time. So please trade accordingly. I want to thank you all very, very much for joining us. If you have any questions, you can contact me directly, www.coreaccounts.com. Very special thanks to FX Street. Please see their calendar because I'll be back on later on in the month with much, much more. Again, we thank you all very much for joining us. We wish you a great day. Back inside FX Street.